welcome, world. Welcome to the first episode. This is the initial jump off for the Stocks is Talking podcast with Ibn Getz. I'm your co-host, Ibn. My friends call me Ib. That means you, the listeners, you call me Ib. And my co-host, Getz, is in the building. Please say what's up to the people, Getz.
What's going on? How you doing?
I'm doing good, man. I'm doing good. How you feeling? Let me first jump off and let everybody know what this podcast is all about. We're here, two young black men who love the stock market. We're into making money in stocks and strategizing, understanding new concepts, techniques, the hot stocks, the dividend stocks, whatever, equities market, Forex. We're interested in it all. Now we want to do a podcast. This is us. The Stocks is Talking with podcast with Ibn Getz. This is what we're about. And first off, Getz, I wanted to start with, why do we get into it? How do we get into it? And why do we do it? For me, I've been into stocks since, I think I helped my father get money on his first stock when I was 16. He had kind of put me up on game. I did a little research, said, hey, check out this stock. He made some money and ended up giving me some cash from his stock that he made off of my suggestion. So that was my initial taste of the market and the fact that I can actually do some research, pick a stock, buy it, and sell it for more than what I paid for it. That's how I got into it. And, you know, I'm 34 now, and I still dibble and dabble, and I love the market. Getz, how did you get into it? What made you get into it? Why are you on this podcast?
For me, it was, I think somebody at work initially, they got me into it, and dibbled and dabbled a little bit. Nothing but losses.
Okay.
And then got up with you and your pops, and, you know, got schooled a little bit. Okay. And I made some money by accident one day.
Made some money by accident on an option. Hold up, because you talking about options already. I want the people to know, if you don't know what an option is, we're going to get into it. Right now, we're just talking, letting you understand who we are. Options, You don't even understand, Getz. That's an advanced level of trading. You just go out there very casually, very nonchalant, but that's what we're here for. We're here to talk stocks. You jumping out there early, quickly, but I want to let the people know we're going to get into options. You'll understand what that's all about if you stick with Stocks is Talking with Ibn Getz. Please continue. Continue.
So I made a little money by accident on an options trade one day while I was sitting at work.
Okay.
And you know, so that got me back into it, because I was like, I'm done. I don't want nothing to do with this.
Really? So do you remember what stock it was? What stock had you, you know, what gave you that first little taste of money in the market?
It was Bank of America. Okay. And it was, I want to say it was about 5 years ago. I think it had something to do with Trump. Before he got in. Yeah. It was when that was just starting, the whole Trump trade hype. I opened up an account one day that I hadn't looked at in forever, probably a few years, and there was like $1 sitting in it.
Okay.
I see the
$100. Everybody out there who doesn't know what a buck is, it's $100. Please understand, streets is talking. Stocks is talking. That's where it comes from. We two black men that know a little slang vernacular that we bring to the stocks game for. So if you don't know, a buck is $100. He looked at his stock market account and saw another $1 in there. Just keep flowing with us. You'll understand the lingo. Yeah. Please continue.
Yeah. So I saw that in there, and I threw some money on Bank of America, BAC, and I let it ride. Forgot about it. Looked at it the next day. I think I was riding around at work, and look at my account, and I'm up like 500. So I'm like, okay, I'm gonna take that. So
okay.
So I take my money out, but now it got me thinking, well, if I could do that in a day, you know, what else can
you do?
Yeah, you know, and it just grew from there.
There you go. And the rest is history. And now we're doing a podcast to just kind of give the listeners some game on the markets. Cut gets, and I'm gonna put out there. We're not gonna dance around it. We cousins. We family.
Mm-hmm.
Not necessarily blood cousins, but we family. So we doing a podcast together because we have these talks on a consistent basis. Because 5 a.m., 6 a.m. What'd you say?
Almost on a daily.
On a daily. So we're bringing it to the podcast platform for all the listeners out there, whether you're in Australia, you might not be yet, but one day you will be. Compton, Baltimore, Jersey, Alaska, Wyoming, wherever you are out there. Now we're going to bring you into our personal convos on the markets. So you talked about options. What does that mean? Because a lot of people are listening. We're just going to get right into it. We don't do an outline on the Stocks is Talking podcast. We just flow and have some good engaging convo. What is the option from your perspective? I could jump in, say a little bit from my perspective of what an option is and how can you make money off of it. But what's your thoughts on that?
I mean, to put it in the simplest terms, the options is you're placing a bet. You're betting whether the market's going up or down, or whether individual stocks going up or down. That's the simplest way to put it. You know, you choose your strike price, your price that you were expecting, you know, or your target price that you're expecting the stock to go to, and you place your bet. And
so let's give an example. Let's just stop on that real quick and give an example. You have a strike price. You want to make a bet that is going to that price. What does that look like? If the stock is, let's say you got Apple at $50, what kind of potential options trades would you look at making in terms of the strike price, how you make the buy? What does that look like? Apple's trading at $49 right now. What are you thinking as a trader?
That'd be amazing. But
one, why would that be amazing?
That'd be amazing. Just because looking at what the price is now, you know, especially after the split and everything like that.
After the split, what is that?
Yeah, I mean, they did the 5-for-1 split, I think it was. So they were I think they were at 500. They did the 5-for-1 split, so they went down to $100. Right now, last I checked, they're 121, which is down.
Okay.
Which is still a lovely price. You know, I know you got in early.
Yeah, I've got in early, very early.
Yeah, you got in super early.
Yeah.
You know, but if you got a stock like Apple, it's at $49. I mean, there's a lot that goes into it. Mm-hmm. But you know, you're looking at your time frames.
Okay.
How far do you want to go out? Are we talking a month? Are we talking a year? You know, because you could if you're talking.
So let me just take a quick pause for what we're talking about when we say go far out. With options, if you don't know, you place your bet as gets mentioned, but you place your bet and it has an expiration on it. So right now, today is Sunday, March 28th. Friday is April 1st, I believe. So you can purchase an options gamble, but that option that bet you place will expire on Friday. Meaning you have to buy and get out of it by Friday or all your money dissolves.
Right.
Plain and simple. If April 1st comes on Friday and you haven't either sold it or extended that option, and that's whole next level we'll get to way into the podcast weeks, months from now, you have to sell it. So the point is that option has an expiration date. So when he says goes far out, he's saying the expiration date is farther out. So it's maybe April 15th or April 28th or August 2021. So you have a few months. So please continue with, so if Apple is at $49, please continue.
Yeah, it's at $49. I mean, we could say Apple's at $49. I mean, we don't want to get too deep with it. I mean, but because you got your in the money, out the money, stuff like that. You know what I'm saying? Which I don't think we should get into to start off with. But if it's at 49 and we're going through a market like we're going through right now and Apple's down, but you see the potential that in the next couple of weeks Apple's going to go to 60 or, you know, a 70. Well, then you could say, you know, all right, I'm gonna buy at a $60 strike, you know, which is out of the money. It's going to cost you a little less. Your premium that you pay is going to be lower.
So $60 strike, meaning that's your target that you're placing
That's
your
your
bet
target.
on.
Mm-hmm.
That it's going to hit $60.
Right. So
Okay.
So if you're going for a $60 strike, if that's your target, when you go 2 weeks out, on a weekly contract, or you actually, I mean, at this point, today's date, maybe you go on a monthly contract, so you get the middle of April.
Okay.
Now,
middle of April, people, we're saying, you know what? Put your money on Apple. It's going up. I'm betting it's going to 60. Mark it in. Give me a little bit on Apple going up. That's pretty much what you're saying when you say $60 strike in a couple weeks. In a couple weeks, it's going to hit 60, and I'm going to make money as it continues to go up towards 60. Because right now it's at 49.
Right, and obviously your risk reward on an option is way better than it is on a stock. I don't know if you want to go into that.
Well, what do you mean when you say risk reward? Try to explain to the people what you mean by that.
Well, all it is that your stock is at $49. It goes to 60. All right. You made $11 a share, right? Mm-hmm. You have 10 shares. You made $110,
right?
Well, if you went and bought one contract, depending on the premium, which is what you're paying for, it's one contract is 100 shares. So whatever the price is, you times it by 100. So let's say it's $5, which would be 500.
Right.
You put up that 500,
and now you have 100 shares worth of the company.
You have 100 shares. You have the potential to have 100 shares of the company.
The potential to have 100 shares.
Yeah, because you don't actually own those shares yet unless you exercise that option.
Because right now you have an option to buy it or the option to sell it.
Right.
And you have the expiration date to determine what you're going to do. Are you going to exercise your option and now buy it, or are you going to now sell that option?
Right.
Okay.
So let's say, if we're not exercising that option, if we're just going to hold the contract and build on that premium, if we started, it cost us $500 in the beginning. By the time it goes to 60, especially if the market is like right now and the price is depressed. So we're buying a red day. The market's down.
Okay.
It's
a red day means the market's down, people. If you see red, that means people are selling, which means you should be buying. Quick tip from the Stocks is Talking podcast. This is the first one, Gets. This is the first we want to give them. Quick tip: buy on the dip, sell at the tip. Mark it down, people. You're getting big tips from Gets and Ib. That's the first one. Buy on the dip, sell at the tip. Go for it.
Like they say, you be fearful when others are greedy. Be greedy when others are fearful.
Ooh.
Right?
Ooh, give that to him again.
Be greedy when others are fearful. Be fearful when others are greedy.
Ooh.
So when everybody else, when you have all this euphoria in the market and everybody's piling in, they're being greedy. That's when you should be stepping back. But when the market is falling and everyone is fearful and they're selling everything because they just don't know any better, that's when you should be greedy. That's when you should have your money to the side. That's when you should be, every time as those shares drop and those people want to sell, you need to be that point of liquidity. You need to be that, you come in and you're just like, hey, you know what? I'll take those shares off your hand. If you believe in the stock, if you believe in the company, then why wouldn't you? If they're in, if they're trying to sell something to you for well below what you believe its intrinsic value is, then why wouldn't you take it?
Why wouldn't you?
Right.
But let me just tell the people why they wouldn't, because they don't know any better. They're not educated on you buy on the dip, you sell on the tip, which is why the Stocks is Talking podcast with Ibn Gets. We're here to kind of help people that may not know. This is stock knowledge for the common man, for the common people. We're out here
Right.
talking in the common language for everybody about a market that only a 1% is really making money from. But we're bringing it to you in our own language so you can understand this is not just for Wall Street, this is for everybody if you have the education. So when you say,
Right.
why wouldn't people jump in at this price point? Because they don't know any better. But please
They
follow
don't.
us, subscribe to us, share this podcast with your people, and I promise you, you'll all understand. Buy on the tip, sell on the tip. Please keep going for them, Guts.
I mean, you need to jump in here at some point. I mean, this is
I want to talk about looking into stocks for the future and give a quick story. Plug Power. Do you remember Plug Power?
Oh man,
Are you familiar
yeah, I
with Plug
remember.
Power?
Yeah.
Okay.
Preach.
So, about, what was that, 3 years ago? 3 years ago, maybe it was 2.5, 3 years ago. Plug Power, this fuel cell energy company, they were at about hydrogen fuel. They had warehouse contracts with Walmart, which really caught my attention back then. They were selling,
and they had the Amazon deal. They did the Amazon deal.
They had the Amazon deal. They were trading at what, $2 and some change?
Something like that, yeah.
And we were having our weekly small cap conversation, just talking small caps, what's doing what, and somehow Plug Power got into the mix. And you and Ace, you all downplayed it. Oh, plug. I don't see it. The valuation's not there. They're not making any money. They're not going to turn a profit. I wouldn't mess with them. I said, okay, I'll buy a couple shares. Let's just see what happens. At $2.20, I'll just check them out. So I buy them. They kind of fluctuate between $2.30, $2.50. They're not doing too much, but I hold. There are few sales. They have a contract with Walmart and Amazon. That seems positive, right? So I'll put them off the strength of that. The fundamental aspect of having that kind of business and clientele tells me you're going to be around for the future, because Amazon's not going anywhere. Walmart's been around for years, right? So if you're doing business in a company, in an industry that's a little bit new, a little bit nuanced, hydrogen fuel cells, and you have a contract with this company, okay, I'll mess with you. So I had 200 shares. 200 shares of this company, and they kind of teetered back and forth. Are you in a position to look up what Plug is now? And as you're looking up what Plug is now, let me tell the people what I proceeded to do. And this is another lesson. If you have a hunch or an idea about a stock and you feel like the future for them looks bright and others don't see it, trust your gut, trust your energy, and play it off that. Because I felt it would be a good stock, and I purchased it and ended up selling Plug at about maybe $3 or $4. I sold them. I kept maybe 5 to 10 shares of them. But I thought, you know what? I took some profit off the table. They went up to $4 or $5. I can't be mad at that, right, Getz? Why would I be upset? My people are telling me, hey, they don't like it. It's not going to do anything. It's just a facade. Right now, it's just a trend. Get out while you can if you made profit. Trust me, you're going to hold too long. You're being greedy. You need to take that profit. You're making a little bit of money. Jump out, jump out, jump out. Even my father, jump out. I don't know about Plug. Jump out, jump out. Let me know when you're close to having that number for what Plug is at the moment.
I got it. I got it right now.
Okay.
Yeah, I got it. Plug is at $34.02 right now.
Hold on. Say that again.
I'm trying to get $34.02 right now.
Okay, $32.02.
Yeah.
Okay.
But hold on, because I'm gonna give you the give me a second. I'm gonna give you the 52-week high.
Oh, the 52-week high. So let's stop for the people and let you all know this is a nugget. If you're just getting into stocks, you're curious to how do I even make a potential good move in purchasing a stock, jumping out there. What do I look for? You look for a 52-week high. What has that company done within the 52 time frame? What's the high? What's the low? Because here's what you're looking for.
So the low
is
$3. $3.22.
$3.22. Remember, people, I sold it between what, $4 to $5 a couple years ago. Okay.
The high is $75.49.
The high is $75.49. So let's just look at that really quickly. I love to do numbers, and I'm still hurting about Plug and selling it, because I'll mention to you, and this is no cap, as the kids say. I was going over some stuff with my father, who we'll definitely have as a guest on the Stocks is Talking with Ibn Getz podcast.
Definitely
for sure.
Have this conversation with him.
For sure, absolutely.
Yeah,
absolutely. But this is no lie. He was showing me some stuff, and he's a very low-key bragger. He's very humble about it. So he's just perusing through his account, and I see he's up $30,000 on Plug Power, because back when I sold, he was like, "Oh, you still have your shares, right?" I'm like, "Nah, I sold because you were downplaying them." And so was Getz and other folks. So I got out and took my little profit. So no, I missed out on the $30,000 you're making, because Plug at that point, Plug was up to like $80 or 70, whatever the high is. That's what Plug was.
$75.49.
And he had like a bunch of shares. He had about 1,000 shares of them. Because again, they were down to $1, $2 at one point.
Now, let me say this. Please though. Say it. At the time,
please defend yourself now for the horrible advice.
At the time. Now, I was a day trader at the time, right? I wasn't an investor. You're an investor. I was a day trader.
We definitely have to break down what that is. It'll probably
hold on, we'll get into that, right? I'm gonna let you get into that.
Go for it.
But I was day trading at the time. Okay. So my thing was in and out, right?
Right.
I understood the fundamentals of companies, but my thing was always in and out. I didn't stay in a company. I didn't invest in the companies, right? I get my money and I run. You invested for the long run. So, first thing I'll say is, it's your fault that you sold, because you're an investor, right? I was a day. Okay? We're going to get that out the way right now.
Okay. I like it.
Second,
at the end of the day, it's on me for selling.
It's on you for selling,
Absolutely.
But it is what it is. You live and you learn. Hindsight is 20/20.
Absolutely.
Now, as I've grown in this market, I understand what it is to invest and what it is to look to the future. I didn't understand it at the time. The stock market in itself is always looking forward. It's always looking 6 months, 12 months, 18 months ahead.
Talk.
So when you look at some of these stocks and you look at their market valuation, it may make no sense to someone looking in who doesn't understand. Because they may say, well, this company is not worth $900 billion or $1 trillion or whatever it may be. But for the market that's always looking ahead, it's not connected to the economy. The economy is right now. The stock market is what the economy will be. So and I didn't understand that at the time.
Help us understand that.
So the stock market is pricing in what a company will be, what it will do, not what it is right now. Okay. And that's the thing that I didn't understand at the time, and that's what everybody needs to understand. If you look at the economy, you could say, well, the economy is doing bad, the economy is doing good. The economy is suffering, the economy is recovering. When you look at the stock market, just like over this last year, this is a perfect example. March of last year, there's a pandemic, the market crashes, right? Because things are closing, because it's looking ahead. It's saying, well, if everything's closing right now, then that's going to hurt the economy down the line. So the market's crashing. And then as a little time goes by, the market starts to price in. Well, what happens when the economy reopens? So now you start to price that in, that 6-month, 12-month, 18-month timeline. So now you have these recovery stocks that you could have bought for dirt cheap, your airlines, your cruise lines, whatever.
Which I jumped into Caribbean, American Airlines, United, and JetBlue. And Caribbean, Norwegian. These are all stocks to write down.
Right. And I was skeptical, because my thing is show and prove. Even as an investor, I'm show and prove. So I'm not gonna wait until everything is set in stone, but I need to see that you're gonna survive.
Okay.
That's the way I invest.
You're gonna survive the economy?
You're gonna survive the economy. You're gonna survive whatever the environment is. That's my thing. So I'm willing to pay a little bit of a premium, so that way I've already seen that you can make it. So you have the right management.
Do you have an example? Right. Do you have an example for companies where the market's tanking because it's a bleak environment that we're living in? The pandemic hit, things are closing up. What are you buying at that time? Outside of the travel companies, because I think
outside of the travel companies. Well, you know what my biggest right now. One of the things, it's kind of tough to say, because I got a few things that I'm into right now, but a big thing that a company that I love, that I've been watching for a while and I'm invested in, Disney.
Okay. Disney. What about Disney? Because of course we all know them typically for the amusement park. The Super Bowl, they win, they have a commercial, we're going to Disney World. That's kind of how we look at Disney.
That's how we look at Disney.
Correct.
But Disney is the everything company. Disney is the theme park. Disney is the Marvel movie. Disney is the Star Wars movie. Disney is now the streaming service. So they're now a technology play. They're a competitor to Netflix. Disney is everything. They are a conglomerate of all these businesses. Disney is ESPN. Okay, sports shut down. That's Disney.
So you're saying Disney has the infrastructure to sustain, or to, I guess, come back from a pandemic and not be so hurt, because they have other streams of revenue, to where now, if the amusement park platform is down, now they just go to the digital side. So now they're a top competitor in that sector. If that goes down, now the amusement parks are open. So they're the number one attraction on that side.
And that's all due to management, though, if you think about it. Because if they don't have the right management, then they won't survive, right? Because if you think about it, if the amusement parks are closed and you have no sports, so you have no amusement parks, you have no ESPN, right? Now, what do you have? And the movie theaters are closed. So now what do you do, right? Because and then I think movie production got shut down for a while too.
It did.
So they have a lineup of movies. They have a schedule. They have movies that are already done. They're in post production, all that stuff. So maybe they have movies that are ready to come out. Well, now, if the movie doesn't come into the theaters, then you're not making the money off those movies. If the amusement park's closed, you can't start a new ride because of this new Marvel movie. There's no sports, so you have no ESPN for people to sign up for and watch and all that. All those things are closed.
You've got to improvise. You've got to figure it out. What's your business model?
Right. And then you have, but this is the thing. Now that I understand, is you have these companies with incredible management, like Bob Iger, who was the CEO at the time. He's now the chairman.
Of Disney?
He stepped down from CEO. Yeah, of Disney.
Okay.
You have someone like that who innovates, and he understands. And not only does he innovate himself, but he understands having the proper management around him to innovate. So
innovation. That's something we have to just highlight quickly. Innovation. If you come across a stock that is innovating in an industry, pay close attention. If they're at a low price point, invest a little. Innovation is key. Innovation. Please continue.
Yeah. So you have this stock, you have Disney, and you're not just, and this is my thing, whether it's Disney or there's some other stocks I could name, but you have the stock you're not just investing in the company, you invest in that management that is innovative, right? Mm-hmm. Because without them, you don't have the innovation. Mm-hmm. So you have someone like Bob Iger.
Why is that key? Innovation. Why is that so essential?
It's key for growth.
Okay.
You're not going to move on from you can have a conglomerate that's worth hundreds of billions of dollars, and if you look at history will show you that doesn't guarantee you success.
Okay.
Right. So if you look at your Sears, your Bradley, whatever, right? You look at all these companies, they had the wrong people at the helm. So they didn't innovate. They were stuck in times of past. So,
and are looking towards the future and investing in technologies of the future and future business models of inclusion and customer service, all wrapped into it. Okay.
Right. So if you have Amazon comes along and they say, we're the everything store and we'll send everything to you within 2 days. And now the incumbent, the guy who was already there, Sears, and Sears says, we ain't got nothing to worry about. They don't innovate. They continue to keep their stores the same way, this and that. And eventually they become the dinosaur.
Yep.
They go away.
Never to be heard from again.
Right. And just Sears, Circuit City, Radio Shack, Blockbuster. These companies are gone. But if you look at them, look at what they did, what their industry was, what they were into, you'll find someone else who replaced them.
Funko-Land. Do you remember Funko-Land?
Funko-Land. Oh man, I forgot about Funko-Land.
What was Funko-Land again? It was a competitor to Blockbuster, wasn't it?
It was Blockbuster. I feel like it was a competitor to GameStop too.
At GameStop.
I feel like
this is because Funko-Land was before GameStop, was it not? Was there a GameStop back when Funko-Land was around?
No, it was Funko-Land was Funko-Land was a predecessor.
Yep.
So you have the old guard who says we don't need to change, and then you have the innovator who comes in and says we're going to shake things up and is willing to take the risk.
I.e. Uber, i.e. Postmates, i.e. Uber Eats, i.e. Facebook. These are those things that have come and shaken up an industry and changed it. I.e. Airbnb.
Yeah. You know what? You remember when we invested in Facebook?
I remember. So I think this is a great way to touch on this story in the pod, to be honest, this first episode, because this is a great lesson in investing. Facebook. I'm going to start it off because feel free to finish it. Or you can start it off and I'll finish it.
You know what? I don't know if I want to speak on it because you know what? No, let me just say this. All right. Because this was super early in my investing days. Right.
Okay.
So I remember being at work, me and you, we talking about Facebook, we talking about the IPO.
Yep.
IPO
is an initial public offering, meaning this company is now going to be traded on the stock market Previously,
Right.
it was not. Now it's public,
Yeah.
so we can purchase shares of it. Go ahead.
Right. It was a private company. There are laws that govern who can invest in a private company. You have to have a certain net worth, which, most people don't qualify for, right? I think it's like $1 million or $2 million, whatever it is. So we didn't qualify for it. So they have the initial public offering. Me and you were talking. We said we're going to invest in Facebook. So and not knowing how an IPO works, we wait. It finally comes up it finally comes up for sale.
Yep.
So we buy. Because I think
At
the
what
initial price
point?
was supposed to be in the 20s. Hold on. I think the initial price was supposed to be in the 20s. I think we bought in the 40s.
Yep, you're right. 40s or upper 30s.
Right. So we buy. Definitely well above what the initial numbers were.
It drops like
and
immediately.
Then it tanks. It tanks. We buy it. It tanks. Right. We don't know no better. We just see that we're making money, right? And this is one of the things that got me out of the market.
Okay. It
tanks that back down to the 20s. I say, I'm done. It's at like $25. I'm like, yo, I'm out of this. I sell off whatever shares I have. I'm gonna just take what I'm taking my ball and I'm going home.
Yep.
Right. Whatever little money is left, I'm taking it and I'm out.
Yep.
So we do that, and for me, I was like,
and we feel good about that. We feel good about that strategy because it's like, look, we got in, it sold off, it was a bad investment. That's where our mindset is. It came, we thought it would be this $100 stock, it dropped to $20. Let's get out and at least not lose it all. Let's just get out. Yeah. And we feel good about that decision.
Yeah, and that's a lack of understanding. Because we're not looking to the future. We're looking to right now.
And let me jump in really quickly to throw in my lesson of what this tells me about an IPO where there's innovation, because this is what you touched on. And this is what we highlighted. Facebook was changing the social media game. It was a little different with Facebook. And they came up as an IPO. They were an innovator in the social media realm. They really found a way to advertise and monetize, which Snapchat had an issue doing for a while. We can get into Snapchat because honestly,
hold on, before we get into Snap, because you gonna put me on blast again.
Oh no, I'm not even gonna go into Snap. Not on this episode.
But hold on. Okay, but hold on. With Facebook, let me say this one thing. With Facebook, when they went public, they did not. Mobile was growing.
Yep.
And they were not growing with mobile at the time, right? Were a PC-based social media platform.
Okay.
So if you definitely had to be someone who was looking towards the future to see what was going to happen. At the time, with mobile growing, that's where the money was. That's where it was going to be. Now, at the time, that's not where it was.
Where was it?
It was at home on a PC. It was at home on a PC, but there was a limit to that.
Okay.
Now, being where I am now, hindsight is 2020. Mobile was growing, and Facebook, being the innovator that it was, they figured out how to monetize mobile, and that's why they grew. Because if they stayed as a PC platform, they wouldn't have grown.
They had to leverage the growth of mobile, and they had to find a way to wiggle their way into that. How can we now be mobile with the world?
Right. And you saw it as time went on, and it didn't take long. after them being public. And it was like, I think the first 2 quarters, it was, things were rough. The first, quarters, there's 4 quarters in a year, so it's 3 months for every quarter. So
January, February, March is 1 quarter.
Right. So for the first couple of quarters, maybe it was a little longer, Facebook wasn't doing much of anything. They weren't doing anything amazing.
Mm-hmm.
But then when they figured out how, as you put it, how to leverage mobile, when they figured that out, because obviously they had been working on it, they're very intelligent people. Once they figured that out, then all of a sudden you had a earnings report. You had a quarter where it was like, well, now our gross margin on mobile is this, and it's like, whoa, wait a minute, we weren't expecting that. All of a sudden there's this money coming in that wasn't expected.
And they kept building and building.
Yeah, and they're still building.
And they stole shamelessly. I'm gonna put it out there. It's the first podcast. Yeah. I'm gonna get a little provocative. They stole shamelessly from Snap, which is what kept them down for so long before I was able to ride the huge wave of Snap. Because they're now at 50, 60 or whatever.
Yeah, that wasn't the first one. Snap wasn't the first one they stole. They've been, and they're not the first company to do it, right?
Of course, no. That's an underlying business model of all companies that they don't tell their employees about or put in any kind of, emails. But they want to steal shamelessly. If they see a young company that people don't know about doing something that is making an impact, they will bring that into their systems and figure out how to tweak it and put their name on it. Right,
and Microsoft was is the biggest example of that.
How so?
Microsoft used to have, and this is why they had the whole monopoly, the trials, and they almost got broken up. Microsoft.
I'm not familiar with the trials.
So Microsoft went through these whole trials because they were considered a monopoly.
Okay. Monopoly in what space?
And just, you know what? That's a good question. I don't know if it's as a business. So let's just say in general, they were considered a monopoly. As a corporation, they were considered a monopoly.
Okay.
They had their operating system that was installed on everything.
Yep.
They had their internet browser that was installed on everything.
Yep.
And then the other thing that they did was they had all these smaller applications or programs, because nobody said apps back in the day, right? So,
for example, Microsoft Teams I use on a regular will be an example of this other application through Microsoft that they're now leveraging.
Right. So back then, whenever someone else would, another company, you'd have the small company, right, would start up and say, we're going to create something like, let's for an example, let's say Zoom. A small company would come up and say, we got this program called Zoom, and you can talk to people online with video. Well, then Microsoft would say, well, we got a program called Microsoft Teams or whatever. And back then, people would say, well, Microsoft has this program that's coming out, April 15th, so we're not going to use Zoom. We're going to wait.
Right. For their version, their iteration.
Right. And then, but the thing was, Microsoft wasn't ready. They would announce it because Zoom announced it. They would announce theirs. And then when Zoom didn't get their sales, Zoom would go bankrupt. This is just an example, because obviously this isn't fact.
Reality, absolutely.
Yeah. So you have the company Zoom goes bankrupt, or they're about to go bankrupt. And then Microsoft comes in and says, hey, we see you guys are about to go bankrupt. You got no sales. We'll give you 20 cents on the dollar for what you're worth. And they would buy that company, which would then give them the program that they were promoting that wasn't ready. Right? And then they would put that out as their own, as Microsoft Teams.
Would they also get all intelligence for that company they acquired?
Right. That would be part of it. They would get all the intellectual property.
Yep.
Right. That would be part of the deal. They own all of it now. So now they would do that. Right. So now this other company, Zoom, is gone. Now it's just Microsoft Teams. So Microsoft Teams, and then Microsoft Teams would sell to millions of people. And it just, you know, the with these incredible margins, and it was this amazing thing. And Microsoft is the best.
Yep.
That's what everybody on the outside saw.
They didn't see the inner workings of them coming over and eating them whole, and taking their intellectual property, taking their business model when it comes to creativity, and utilizing it as their own. Right. But all you see is them.
All you see is them.
And all the glory.
Yeah. And at the end of the day,
how it goes.
Yeah. And that's all that matters. At the end of the day, if they paid for the IP, the intellectual property, then it's theirs.
Yep. So it doesn't matter how they got it or what happened in the past. The point is, as of right now, today, April 28th, this is ours.
Yeah.
So we're gonna now take this and push this forward, and the people will see it in commercials and buy it, and we will continue our profit margin. Yeah. Continue to expand.
Which, if you look at the way things have changed so much, because if you look at now, I think IBM was one of the companies who really understood it early, that intellectual property was so valuable. IBM, even though they sold computers and stuff, their money was from intellectual property.
Right.
And a lot of people didn't understand that. So now when you look at these companies, they spend so much money on lawyers and everything else, so that they own their intellectual property, their IP. That's a thing back in the day.
Right.
If you were small starting up, then the bigger player would just eat you alive and take your intellectual property, take everything you had, and
keep it moving.
And keep it moving. And hopefully you didn't go bankrupt in the process. Hopefully you came out, whole. But they didn't care if you did or not. But now people understand it, that IP is king.
Yep. Which is why Snapchat, for a while, Facebook wanted to buy Snapchat. And they wouldn't sell.
Yeah, they offered a lot of money.
They did. They understood that their creativity and what they were innovating on was far too valuable, and you couldn't even scale it at the time to say, I'll put this price number on it.
Right.
Because they saw it into the future. They saw what their innovation team was doing and creating.
Right.
And Facebook saw it as well, which is why they tried to buy them. And why they stole from them over and over and over again. But Snapchat survived.
Snapchat survived, but it did help Facebook.
Absolutely. It absolutely helped Facebook.
It did help Facebook, because you have a company that was getting so big, it may be even resting on its laurels. And then you have a competitor come in and they see a threat. And when they wouldn't sell, then that makes them hungry, because it's like, all right, you won't sell to us. Now we got to crush you.
Yep.
And I think there's actually something came out during some congressional trials, something that, where Mark Zuckerberg, the CEO of Facebook, I think he kind of came out and said it.
Said what exactly?
That he was targeting Snapchat.
So he actually named Snapchat.
I think he actually
congressional hearing.
This is hearsay. So
okay.
But I think he actually named them in some hearing. It was he didn't name them in the hearings, but when they did the discovery, they looked into emails and things like that. Then it came up, the things that he was saying about Snapchat and companies like that.
So he saw them as a threat. He saw them as a prime competitor.
Exactly.
Someone that he needed to acquire or crush.
Exactly.
Got it. And that's the name of this game, cuz companies either get acquired, crushed, or they maintain and continue to level up and grow and innovate in their own right.
Right.
And it's our job to find those companies and purchase them for long-term holds, where we buy the stock outright and sit on it, or options plays where we think, you know what, in 2 weeks, Apple is going to come out with this new product, and I'm sure the stock price is going to go up. So let me do an option where in the next 2 weeks, if it shoots up, I make money.
Right. But now, hold on. Now, if we talk about, you say 2 weeks. Now, here's my only issue with that. If you say 2 weeks, if you're getting into options, which, we got to get deeper into later, but if you get into options, now, if you say 2 weeks, if you're playing with options 2 weeks out, then your strategy needs to be basically buy the rumor, sell the news.
Okay, and how does that work?
You need to be, when someone's talking about something, when there's a hype that this may happen, you should be buying, right? Okay. There's a hype around something. Apple says they're coming out with a car. Okay. How likely is that? Maybe it'll happen. It's not going to happen tomorrow, right? It takes a lot of work to build a car.
Right.
Okay, but that's a rumor. While there's the hype there,
buy it up.
Especially if you can get in early, right? You buy up the hype, and then before that dies down, and there's a bunch of ways to go about that, you want to sell it. Okay. You want to buy it up while it's still low, when that hype is first starting, while it's bubbling.
Okay. And then you want to sell once the news comes out, like Apple came out with a car, or Apple decided not to create a car.
If you're sitting at home on your couch, right, and you already bought it when it was a rumor that you heard, through the grapevine. Well, when you're sitting on your couch and CNBC comes on and they start talking about the Apple car, well, now you need to sell it.
Because the news can come out and everybody knows about it.
Right. It's news now. It's not a rumor. It's news. Apple just announced that they're coming out with the car. It's like, go ahead and sell it.
So wouldn't most people think now's the time to buy the stock because the news just told me Apple's creating a car? So wouldn't everybody want to jump out and buy it? And wouldn't that make the stock go up?
Possibly.
If I'm not a seasoned trader and I don't really know much, but I'm interested in making money in the stocks, if I see that on the news, I'm going to try to figure out how to create an account and maybe buy the stock because CNBC told me Apple's coming up with a car. But you're saying sell the news now that it came out on the news.
Yeah, because the institutions are selling. They already bought. The institutions, the companies, the banks, everybody else, they bought early.
That's a nugget. That's a nugget right there. There's two separate stock market games.
Right.
There's the small time investor, and then there's the institutions.
Right. And like they call it smart money and dumb money, right? They call the institutional investor the smart money, and they call the retail investor the dumb money, right? Because they think that we don't know nothing, right? So if you're
here to break that stigma. I'm sorry to cut you off. That's why we here, because we the smart money too, and we're not going to stand by anymore and let this because the big money is what's been squeezing the markets tight after the GameStop debacle after AMC. So they've been kind of the big time institutional holders are what's making the market lag nowadays.
Right.
And we know that because they're trying to teach those GameStoppers and those Reddit participants to say, "Oh, you all think you can move the markets? Watch how we move the markets."
Right. Yeah.
That's just my personal thinking.
And I agree. I mean, if they've controlled the markets for this long, they're not going to be okay with it changing.
Why is that?
Because that's where the money is made. Look at J.P. Morgan. If you go and actually listen to earnings calls or read the earnings reports, J.P. Morgan they're one of, if not the biggest bank because of the trading desk, because of the trading. Because you have the retail investors, the normal person comes in and they're investing, but their trading desk, they have these traders that are there. That's all they do. And every time you sell at a low, they're buying.
And every time you're buying, they're selling.
Exactly.
So and the key is, how do we buy when they're buying, and how do we sell when they're selling?
and that's what everybody's trying to figure out. And there's a whole bunch of there's a whole lot of ways to get data and stuff like that. You have to be willing to actually take the time and go through all the information. So research is key. Yeah.
Research. Now, when we come to research, what are we talking? Because I know when it comes to me and you, and when we talk, you're the research guy, and I say that because you know the financials. You know what happened in the last earnings report. You're reading give the people, what is it that you're reading on a company until you get excited and you're ready to buy? What is it you're seeing in the financials? What are you looking at? What are you researching?
Well, I mean, to start off with, you have your earnings reports, right? Every quarter, right? You have your earnings report. So you get the financials from the company, what they're doing, what their profits were, losses, whatever it may be.
Okay.
And then you have your normal news cycle.
News cycle meaning they came out with a new product. This health company is
researching
a new trial of whatever vaccine.
You have whatever the announcement is, or this or that. New product, new treatments, new this, new that. You have all that stuff that comes out every day. And you have the earnings reports. I actually like to listen to earnings calls because I like to listen to. There's a lot of analysts on the calls, and they ask questions. The questions may pertain. The question, when they ask the questions, it digs deeper into the earnings.
It helps flesh out: is this company for real, or is this just a pretender?
Right.
Pretty much. Is this a company I should invest in for the future, or should I just get an option because they might put some news out, and for 2 weeks they might pop and drop back down again?
Right. Right. So you have your earnings. There's also, my new thing is the SEC filings, right? So
the SEC filings, that's what you've been sending out lately.
Yeah. So
what's that about?
That's my big thing now, right? So every time you have an earnings report, it has to be filed with SEC, the Securities and Exchange Commission.
Okay.
So, but that's not the only thing they file. There's filings going on all the time. Anytime someone in the C-suites, the corporate, offices, sells or buys shares, it has to be filed. So, if an investment firm or anything buys up, I think it's 5% of the company, it has to be filed. If they want to offer bonds, it has to be filed. So bonds is basically selling debt. The same way the U.S. sells debt in the treasuries, companies can sell debt. So, and
they sell that debt to who?
They sell that to the retail investors, to whoever will buy. They're selling it to banks. They're selling it to the people that will buy them. So So they sell the debt, because they want to raise capital. They want to raise cash, right?
Yep.
So
cash is king. Cash rules.
Right. So you have, these companies that if they want to sell you debt, they want to raise cash, they have to file it with the SEC. So you'd be amazed at how many filings there are on an everyday basis.
And your purpose is, I'm going to check out these filings. I'm going to see what you're up to. What are you investing in? What new innovations are you coming up with? And are you something that's going to be sustainable for the future? That's why you're checking out the SEC filings.
Yeah. And the other thing is, right, say you have a company that you think has huge growth potential, right?
Right.
And then you get an email and you see that the CEO and the chairman have sold all their shares.
That's a red flag to me if
Exactly.
I'm looking at it as an investor.
Exactly.
Because if the CEO is selling, why am I holding?
Exactly.
Because they obviously have more information than me, right? Because
exactly.
they got more information than you get. So I'm going to get out if they're getting out.
Exactly.
And vice versa.
Yeah. And the beautiful thing is that they had to file it. So
let me ask you this. Where are you going to find an SEC filing on a company?
Well, I mean, you got to go, if you want it quick, you got to go to the SEC website, right?
The SEC website, okay.
Yes.
Is that free?
It is free. It's free. And then the hardest part is, now, now I signed up for a lot of companies. So my inbox is full.
Okay.
But you can go to the SEC website and you can go on there and you can actually choose, you make an account and you choose what companies you want filings for. And you choose whether you want all of the filings or I forget what they call it, but you can get just some of the filings.
Okay, so like the major filings and not every little filing.
Right. Now, the way I did it, I get all of the filings, which is why my inbox is full. So
makes sense.
So my thing is, because every time, because let's say you hire engineers, right? Now, one of the things they do, because with, the tech industry, they give them shares of the company.
Okay.
So what they'll do,
which is smart,
which is very smart, right? You ain't got to pay cash.
Yep.
But what they do is, they don't give them shares up front. They give them options, and those options vest over time. So they have so much time to turn those shares so much time to turn those options into shares.
Okay.
So when they do those things, there's filings. So you'll see that this executive or this person or that person had these options that converted
into actual stock. So now these people are now invested. They have shares in the company because they exercise those options that they had available to them.
Now, sometimes you'll look at it and you'll see that person, they exercised them and then they sold them immediately.
So they exercised them and then made a profit off of the options to exercise. Right.
Which, I mean, if you're an employee, can you blame them? Because they want to get paid. Right?
Absolutely.
So you have those, but then you'll see a lot of the executives. And I think I sent those. We have our Discord. I sent some in there where it was executives, where it was their shares or their options were exercised, and then they would sell. And
these are that's a telltale sign.
There's a problem.
Which means let me sell or let me buy a put option.
Right.
Let me buy a put option and capitalize on the fact that these executives are selling, which means the stock is probably going to move in a downward trend.
Right.
And if I buy a put option, I can make money as the stock is moving in a downward trend.
Or you
because I'm
or
getting.
short
Go ahead.
the calls, or short the calls, which I ain't gonna get into all that. But
Yeah, you're getting very advanced on them. We can't flex on them that quick. That's we moving too far ahead for the audience. But yes, that's the point though. There's so many different ways and strategies to make money in the stock market, and this podcast is here. We're gonna break them all down for you, and we're gonna break it down in discussion format.
right,
We're gonna have talks just like this one here, where we're breaking down stocks. I think we talked about Snap, we talked about Facebook, we talked about Disney, we talked about Microsoft. We touched on a few key equity companies out here that are great long-term holds and great ways to make option plays. But that's the whole point. We're gonna let you come in on the discussions, into the chamber, and this is just the beginning, Getz. How do you feel about this episode? Because we're gonna wrap it up for the people.
yeah,
We don't want to keep them too long. But how are you feeling? This is the first one.
yeah, I'm feeling good. But before we go, I want to know what are you into right now?
What am I into in terms of what am I currently invested in?
Yeah,
That's a great question. So currently, and again, I'm an individual that likes to, when I see what's going on in the economy, in the world, I like to make trades based off of that.
mm-hmm.
Because those are often times where I can either jump in because there's an immediate upward trend, or everything's tanking and I'm looking forward to 6 months from now or 2 years from now. So to that point, I'm currently holding Caribbean Airlines, Royal Caribbean, Carnival Cruise Line, Norwegian Cruise Line, United Airlines, American Airlines. Do you see a trend here?
Yeah.
Do you see the trend? These are all travel companies because COVID came and hit. And what were people not doing? They were not traveling.
Yeah.
So I bought into all those companies. So those are all up currently because the world is opening up a bit. I also own Apple. That's just a long term. I also own Disney. We've touched on Disney already in terms of the multiple platforms and how they're generating revenue, whether we're in a pandemic or not,
right?
Whether people are traveling or not, whether they're at home or out in the world. And that's a prime example of a great business model, a great business entity when they're making money, whether people are at home or out in the world. Disney's an example of that. I own Square, Cash App, which gets, I don't know if you remember, I've owned Cash App Square since they were at $9. I think Square is at about $200 now. So they're taking off. I sold a lot of those shares over the last couple of years, which I'm upset about. And I think that's about it right now. My newest stock is Fubo. Guess I don't know if I lost you. I'm not hearing you at the moment. But what we're going to do is say, look, this has been an absolutely wonderful first episode. Stocks is talking. Guess, are you back? I hear you.
I'm here.
You're here. Okay, I was just about to do an outro because I didn't hear you and I was just going to keep it running. Okay, you're back. So, like I was saying, Fubo, that's my newest stock that I've purchased recently. And I also have a few sleepers.
Okay.
And I think I want to save the sleepers for the next episode.
All right.
I think I'm going to leave them wanting a little bit more. I gave them a taste of my long-term holds, my travel companies. I gave them Square, I gave them Apple, I gave them Disney. Those are the heavy hitters, the long-termers. Eventually, guys, we got to get into those dividend stocks because I know your portfolio is full of them.
Yep.
We need to understand what a dividend is and why we want to buy them and hold them. But we're going to get into all that and so much more. Again, this is the Stocks is Talking podcast with Ibn Getz. I hope you all were entertained. We had a blast. We enjoyed it. I want everyone to stay positive, stay blessed out here. Keep it moving, keep it motivated, and never get down. Key. This is the key, Getz. We dropped a couple keys. I'm gonna give them one. Don't forget, buy on the dip, sell on the tip. What other keys did we give them today? Do you remember? I feel like you said one.
There was a lot. Buy fearful, sell when others are greedy.
That was the one I was thinking about.
Yeah,
that was the other one I was thinking about. So we gave you all some keys. We gave you all some topics to hit on. We want you to know that this is only the beginning. Please keep rocking with us. I think I'm out this joint. What else?